Okay, so we're back in our demonstration account here. Uh, Now, under the trading with confidence philosophy, we're going to take a close look at closing out this SPY position. We've had this on for a couple of weeks. Now we only did 5 contracts on an iron condor. We're currently down 208 points on the Dow. That brought us back into the sweet spot here. And as you can see, the white line is our current profit position. The green line is our expiration position. Now these are the April contracts that we're talking about down here. You can see these are April contracts. We only have 7 days left on these. Our profit potential remaining on these contracts is only about maybe $83, $84. We've generated $292 in profit on just this one position. This is not our portfolio. This is just on this one position. So we are way beyond the 20% profit that we normally like to take. But we could see that the market was coming into nice, a nice in our sweet spot here, and a nice position. So what we want to do is we want to start paring back on this position. And to do that, we could take off maybe 2 or 3 contracts. Since we have 5 on these, we could take 2 or 3 contracts off on both sides. We do not like to leg out of positions. In other words, because the market is falling, it's down to 211 points now. We don't want to take off our call position, then take off our put position. We could, and by using the Thinkorswim analysis tool here, we could actually take a look and see what our position would look like if we did that. If we took off our call positions, that's what it would look like. We would still have quite a bit of downside here. We could all the way go all the way down to 127, 127 strike, which is our break, not our break even, but our short strike. Our short strike is at 127, and that's where we start to lose money after that if it goes down farther than that. But why should we do that when we have a 80% or better? Let's see, out of a potential of, if we take a look down here in the corner, $375 in potential, and we have a $289 profit on that position now. Why maintain a risky position by taking off half of the iron condor and let the other half ride? Because we could end up in a less profitable position, because now what we're doing is we are now trading price rather than total positions. In other words, remember, most people are not very good at predicting price. I mean, unless you're a superstar, and those are 1% of all the traders in the country, in the world, that can predict price. So what we want to do is we put this on as a total position when we initiated the position. We're going to take it off as a total position when we close the position. So all we have to do is go into here, and we're going to highlight these. And then we are going to right click, and we are going to create closing order. And this brings up our order entry screen. And this is the complete opposite of what we currently have, because we are currently short the 140 calls. Now we're buying them back. We were long the 142 calls. We're selling those. We are short the 127 puts, so we're going to buy 5 to close those out. And we are long the 125 puts, so we're going to sell those to close them out. Right now, the mid price is 15 cents. The natural price is 17 cents. We're going to go ahead and enter this at 15 cents to see if we get filled. And if we don't get filled, let's see what the time is here. It's 13:57. If we don't get filled in 5 minutes, then we can go ahead and change our price on that. It's currently working. The Thinkorswim platform will notify us immediately once we have sold our position out, and we'll give this about 5 minutes. You can see the status down here. It says it's still working on the position, trying to get us out at 15 cents. We always like to try to hit the midpoint if we can. I mean, if we can't hit the midpoint, let's take a look. I'm just going to right click. Here, I'll show you what I did. I'm right clicking on this line here, and I'm going to go up here and go to cancel replace order. I always do this because just in case we don't get filled, I like to see what the current market is. Right now the mid price is at 14, so we should, I'm kind of hoping here within the next couple of minutes we'll get hit at 15 and see if we can't close this position out. I mean, there's no hurry. See, when you're trading with confidence because you have built up a profitable position, now you don't have to get out at the market. You can wait to get your price. If we don't get filled here within a few minutes, okay, we'll change it. If the market makers don't want to give us 15 cents, no problem. We'll go back in, we'll raise our price maybe to 16 cents and see if they'll give us that. But in the meantime, let them work it. Let's see. Maybe somebody will pick this up for 15 cents. We're not in a hurry to get out because we are in a profitable position. A lot of times traders will try to, are scared because they're so close to either losing a profit that they have, or they're in such a bad position and they're losing money on a daily basis that they have to, either they let it run and they totally ignore the position, which a lot of traders do. They keep losing money every single day, but they're like ostriches with their heads buried in the sand, and they don't want to look at their positions because they see how much money they're losing. They get scared. But we're not scared. We trade with confidence. We allow the market to do its work. We try to get the very best prices both when we initiate positions and when we get out of positions. But we do so with confidence because we're trading usually from a profitable position. Now there's a couple of situations only in which adjustments don't work, and I talk about those in adjustments. So go back and take a look at those. But we're talking about closing positions here that are profitable. We can afford to wait a few minutes. It's been 3 minutes so far, about 3 minutes, and we haven't gotten filled yet. That's okay, no problem. We're just going to hang in there and see. Now let's see where the mid price is. See, we can go up to 16 cents. The natural position, I mean, if we wanted to get out at the market, we would go at 17 cents. But you know what? If we don't get filled at 15 cents, 2 cents is not going to make any difference on our position. Unless you were trading 30, 40, 50, 100 contracts, yeah, maybe a penny or two is going to make a difference in your profitability. But when you put this on and you got $1 credit and you're taking, you got 85 cents of credit in here and you're getting out at 15 cents, you can afford to give a penny or two to the market makers to make them happy. Let them take a penny or two here. Don't be too greedy. So we're going to let this work a little bit. Looks like the market's still around 203. Let's take a quick look at our charts here. This is the charts that I told you that I use when trying to determine market direction here, and I'm using a 15-minute chart. And when you take a look at our adjustments and the big picture, and I mentioned this in a couple of other things, you want to kind of take a look and see where the support and resistance points are. I'm not a big technical analysis guy, but I do like to take a look at the trend in general, and you can see it's continuing to go down here. This little cross here might be a stabilization point, and it might go up a little bit here, but yeah, let's take a look at the daily. You can see that the market has rallied from this little bottom here. It's coming back up. As long as it doesn't cut through we had a big up day here and it's just kind of traded sideways since then, but as long as it doesn't cut the bottom of that, I think we'll probably be okay. It'll probably just stabilize or maybe even go a little bit higher from here. Let's take a look at the VIX as well. The VIX broke this uptrend line here. It stayed below it. It rallied back up here, and now we're just slightly over that uptrend line, which means that it may go back up into higher territory. And in our discussion on Vega, you can when the VIX goes up, the market generally goes down. It means there's more fear in the market. More people are buying puts in the market. Let's go back to our trade position here and see what we're doing. It's still working. We haven't gotten filled yet, and it's been about 5 minutes now. So what I'm going to do is I'm just going to raise this up to 16 cents and see if we can't get out at 16 cents. Now, when we do have, see, we've got $305 of profit open on this, and so we'll capture that $305 as soon as we get out of this position. We made $40 just today on this position. Let's try 17. So you don't mind giving up a little bit of profit, but yep. And the VIX is going up, so we had to give up. I mean, we started out at 15 cents. Now, this is a good lesson, okay? So, I mean, most like this morning, I had no problem getting out at my at the price that I wanted, which was really, I think, a penny off the mid price. Here we had to go up 2 cents. We got out at 17 cents here. We started out at 15 cents. You can see down here we got out at 15, went to 16, we got it, and then we ended up getting filled at 17. So when you have a few cents, I mean, when you've got 90% of your profit, this is what I mean. When you've got 90% of your profit, you can afford to give up a few pennies. It doesn't really matter that much. At this point, what I wanted to do was I wanted to pare those positions down. You can see now in the April positions, I've gotten my SPY positions off. I'm not in the April position anymore, and that's the way I want it. I want out of that 7-day position, because the closer you get to expiration, there's all kinds of weird things that can happen, especially gamma risk. The closer we get to, if the market happened to get to one of our strike prices, then we get some weird stuff going on, and I'm going to take my profit at 90%. So we're out of the SPYs. If we take a look at our portfolio now, the only thing we have left on there is the EEMs, and the EEMs are looking pretty good. I'm not too worried about them. It's not bad. Let's see. Now we want to take a look at EEM. I'm still on SPY. We're right in here now on this position. Now because we do build portfolios, we had a lot of different positions on here. Let me just refresh your memory. We had a SPY position that's gone. We had an EEM IWM this morning. We took that off. We still have the EEM and the diamonds we took off this morning as well. So all those other positions are gone. The only one we have left is this one. This one shows still some profit potential here. We can still move down on this quite a bit and still be in a profitable position. Our current profit on this is $138 with one contract. Remember, I'm talking small contracts. These are real live trading positions. So we've got only one contract. Imagine if we had 10 contracts. Okay, now we're up $1,300. If we had 20 contracts, we'd be up $2,300 just on this one position. I mean, how much money do you want to make? That is the only question. Once you learn how to build your portfolio and manage these positions, it's only a matter of size. So now this position, because the market is falling, now we're down 237 points. When we started out, we were down about 200 points. Now we're down at almost 240. This could go down a little bit more, and we'd be even in a better position. We made about $30 today. We have 136 open, but let's see where the expiration is. The expiration is $351. So we've got a couple $100 of profit still in this position that we could take out of it if we hung in there just a little bit more. And since I do not like to predict, price. I only want to manage a portfolio based on numbers. Then you know what? I've got upside, I've got downside. It doesn't matter if the market goes up or down from this point. I'm going to be in a profitable position. So I've got room to let this ride a little bit, and I may do that just to grab a little bit more profit out of this position. So we're going to leave this for now, but this is how you close out profitable positions. If we were in a losing position, if we ever get in a losing position, I'll do a video on that. But this is how you trade with confidence, because it doesn't matter if the market goes up or down. What you want to always want to take a look at is where your current profitable position is, and that's this white line here. Your expiration position is this green line here. And when you hover your mouse over your current position and the live price, you can tell what the difference is between your current position and the profit potential that you have available left in this position, which is about $200 in this little position. So we're going to hang in there, I think, a little bit more because we got room to breathe, and this is the last position in our portfolio that we haven't closed out yet. So that's the end of this video on closing out profitable positions. As you can tell, this is a really good example, I think, because we did have to, we had to go into the market. We tried to get hit at our mid price first. After 5 minutes, if that didn't work, we raised it at a penny. If that didn't work, we raised it a penny more, just above the market, only because the market was moving rather fast, and I think the guys especially SPYs, I've noticed, it's way harder to get hit and filled at the mid price. All right, that's it for this one. Hey guys, trade with confidence.